Hello everyone and welcome back. My name is Greg Furman and this is the Forex Weekly Outlook for the week of December the 12th, 2016. Now certainly with this coming week there will be no shortage of volatility with the FOMC announcement. We're all expecting a rate hike, but we also have a press conference following that. So we don't really know what Janet Yellen is going to say, what she's going to do. The longer term outlook on rate hikes is still very much left up in the air here. So let's go forward now and look and see what we've got with the US dollar. Now, the dollar again is key in not only Forex trading and currency futures trading, but also in a number of different stock futures, commodities. It affects pretty much everything, the direction of the dollar. So right now we've got a fresh triple EMA cross from VantagePoint. Our critical level here is 100.74. You can see we breached that area this past week, but Mario Draghi came to the rescue with the ECB and sent the dollar higher and basically sent the euro lower. But the euro was already predominantly moving. It has been in a rather large downtrend for some time now, so it's basically just a continuation of that. And again, Draghi actually helped that. Now, our neural index is back up in our dollar index. We can see that we're recovering nicely with our predicted differences. Our medium term crossing over our long term predicted difference to the upside is showing further dollar strength, and our predicted RSI is absolutely perfect here at 67.5, all pointing towards further dollar gains. Now, it's not a question of whether the dollar will have further gains. It's a question of whether they're sustainable. And what I mean specifically by that is, again, everything we're doing next week is dependent on that Fed rate hike announcement and the accompanying press conference afterwards. So that could have a very negative effect on the US dollar. There is no guarantee of anything here. So we must, again, limit trade going into Wednesday. Let this event risk pass. Right now, there's an overall bias to the US dollar. But what we want to look at here is 1 year ago. We were in almost the exact same situation, guys, going into a December rate hike with the Fed. And as you can see, that didn't really lead to much. So the dollar held its gains last year at this particular time, but ultimately it went lower. So this is what I want to point out, that this year we're in the exact same situation. The only difference here potentially is that the Fed could talk about hiking more than once in 2017. But if the Fed signals that they're not going to hike, it's a one-off type of hike, and maybe they'll be hiking in 2017, maybe they won't. That's going to be potentially a dollar killer. So be very, very cautious there. And again, I want to point everybody out that we did rally last year after that rate hike, but then we went sideways and ultimately we went lower into May of 2016. Now, with the S&P 500 is feeding off that US dollar strength. Right now, the dollar and the S&P 500 are very highly correlated. They're both going up and down together for the most part. So our key vantage point level here on the S&P futures, 2203.81, very, very strong close, 2260. I think we can thank, I don't know if we can thank Trump for this, but we can certainly point to the fact that after that period of volatility, when the realization that the Democrats had lost, that we recovered very quickly and we've been going up ever since. Now, most people, I would assume, would hold on to their stock gains until 2017. And if they're going to cash out, that's when it would be. Why would they cash out here, guys, prior to January 1st? They wouldn't, because they're going to be paying tax on that. So hold on to those gains, dump out in January. That's what I would watch for here. I think the equities are going to hold their gains, but January, I'm not convinced is going to be a good month for the S&P 500 at all. And I think that the Trump rally, in my opinion, is grossly overextended. But to be perfectly honest, prior to Trump ever coming into this picture, this rally on the S&P 500 was grossly overextended long before Trump ever came around. So now it's just gotten that much worse. So we could have a very nasty January, but for now, right now, selling the equities, obviously that's a very difficult play. We can see the global equities are responding here, the DAX 30. Now, point of interest here, prior to the ECB, we got a triple EMA cross from VantagePoint actually at the beginning of the week, and we broke through this congested area of resistance on the DAX, and this contributed to the euro selling off prior to the ECB. Now, once again, guys, to point out, we had this signal days before Mario Draghi did or said anything. That triple EMA cross, that breakthrough there, that's a fantastic call from VantagePoint in my respectful opinion. And I didn't necessarily agree with it, and I didn't trade on that because of my own personal bias here. But the fact of the matter is, VantagePoint was bang on that call. We're seeing a very similar thing with the Nikkei. So basically, the global equity markets, for whatever reason, love the idea of a Trump presidency at the current time. That doesn't mean going into 2017 they're going to like it. So we have to wait and see what happens there. But for now, selling equities, very, very difficult play. Now, crude oil is trying to gain some kind of downside footing here. Once again, we've got that triple EMA cross from VantagePoint off 48, but we have not cleared this swing high. Now, our critical level with oil right now, the key VantagePoint 18-day predicted EMA is coming in at 150.24. That is this dark colored blue line, but we've got this significant resistance that I've talked about for basically months here, guys, up at this 53, 54 dollar mark, and we still have not broken through there. Now, if the equities do start to tank in January, of course they're going to take oil with it. Now, again, is globally the majority of people are starting to move away from fossil fuels. Once again, I know Trump has talked that he's going to bring them back. I don't believe that he'll have any success with that. I think that greener energy is something that the entire planet ultimately is going to move forward on. So oil, I think their gains should be very, very limited. We may get a little bit past 54, but at this particular time, my optimism on that remains heavily guarded. We can see an early warning sign here from VantagePoint, the medium term crossing over the long-term predicted difference to the downside. So the market's going this way. The VantagePoint predicted differences are going that way. My money would be on the VantagePoint predicted differences, to be very clear here. So I think once again, we're getting an early warning sign. We've got this swing high resistance here at 54, so we'll see if oil can push above that. But again, I think it's going to be very very difficult for oil to make any substantial long-term gains. Now with gold, my viewpoint on gold still hasn't changed here, guys. 1190.87 is the key VantagePoint 18-day predicted moving average. Shorts are good while below that. I think gold is likely to move lower towards the 1060 area going into the year end. But once again, looking at the beginning of 2017, we always want to look at this. But in this particular case, it's very relevant because we're in the same type of situation here. Now, leading into a Fed hike, we know the last Fed hike, we got that hike in December 2015. We went into the 2006 calendar year. The dollar actually basically worked in the price of that rate hike all those months leading up. Once we got the hike, it basically sold off and gold went higher. So is it possible that gold could go higher again just like it did last year? Yes, guys, it's very possible. So we'll have to see what the Fed's again, the Fed is in their press conference on Wednesday, is going to give their economic projections. Very, very important here. In my opinion, it's not a tradable event. You do not want to hang your hat on or count on the Fed to basically go in your way. They're notorious for talking out of both sides of their mouth. I would stay absolutely clear of it, but looking at these repetitive patterns, it would suggest that just like last year, the dollar is working in the price of a rate hike. Now, as we come into the main currency pairs here, Euro US, again, just getting hammered based on Mario Draghi. We had that recovery here that failed. But again, I'll point out where we are here. This is the Brexit breakout point here that I've talked about for the last 6 months. We broke below that right here. You can see the market tanked as it broke through that Brexit low point. It accelerated down. Now, we have congested support sitting down at 105. If we lose 105, we're probably going to move to 104.50. But at this particular time, I'm not at all convinced that we are going to go much lower than 104.50 if we even get that far. And one of the reasons I'm saying that here, guys, is again, if we look at last year, the euro is basically coming back to where it was. That's where we were. So if we look at last year, the euro opened the year, I believe, around 108.56. So it would be perfectly normal for the euro to gravitate back towards that. Now, Draghi and the ECB have made that very difficult, but watch the 105 level, 104.50 level very closely next week, because it's going to be a determining if the euro can continue its downward slide, or if basically we're coming to more or less the end of this this downward rally. But the key vantage point level for next week that you need to watch, 106.72. As long as we're holding below this particular level, shorts are still favored, but a break of 106.72 would mean that the pressure's likely off the downside, and we're going to start moving into a corrective move higher. Now, the same would apply to US Swiss franc. You can see US Swiss franc, we have very strong congested resistance at just above 102. Our key vantage point level at 1.0086. Very, very good trading week on US Swiss franc. With my own direct clients, we've been trading it long only, pretty much daily. We can see we've had multiple tests along this key vantage point 18-day predicted moving average for everybody to see. Buying off this level every single day, closing it, rinse, repeat. So basically what I mean by that is we close it out, the next day we go in and look and do the exact same thing. So next week's level of 1.0086, that is going to be a big level here, but after we get this red hike, my concern for US Swiss franc next week is what happens once we get our rate hike. What happens if we don't get a rate hike? What happens if we get a rate hike and then the Fed signals there's going to be several more rate hikes coming? Well, the US Swiss franc will go through 102 like nothing. However, if the Fed is very indecisive on their views, then US Swiss franc is probably going to sell off between 102 and 103. So watch that area next week very, very closely. Now, with the British pound, interesting play here. The British pound continues to hold above the key vantage point level, 125.44. I see any sell-off likely is going to be limited to this trend line support that I've drawn in here. Comes in around 124.10. Only a sustained break of 124.10 would take the pressure right now, believe it or not, off the upside. Now, again, I think that the British pound, the markets have grossly overreacted to Brexit. Brexit, once again, in my respectful opinion, is a very good thing for the UK. The European Union, I actually like to call them the European Mafia. That's basically what they are. I think it's fantastic that the UK is breaking away from that and going out on their own. But again, the market has reacted very negatively initially, but the British pound is slowly regaining its momentum. I think that it'll be a good trade actually in 2017 on the long side. So we want to watch this key vantage point level at 125.44, the lower trend line at 124.10. Our indicators here are absolutely suggesting that we are immediately going lower. I'll bring everyone's attention here again to that medium-term predicted difference crossing over the long-term predicted difference. Our neural index is down. Predicted RSI unable to hold above 60, and we're now looking at breaching 50. So we probably are starting off the week at moving towards the 124 level, the trend line support that I put in there, but I do anticipate that that's going to hold for now. And I think that, once we get the information we need from the Fed, the dollar is likely to take a pause and probably have a sell-off to some degree, unless the Fed gets very aggressive on a rate hike schedule for 2017. Now, going into the dollar yen, first of all, I want to point out in November, dollar yen made almost a 9% gain. For currencies, guys, that's unheard of in 1 month. So, except for maybe on some of the cross pairs, but not on a stable pair like dollar yen. Our key vantage point level coming in at 112.42. We're closing the week out here at 115.29. The indicators from Vantage Point, believe it or not, are coming off a corrective phase and are anything but overbought. They actually look like they're getting ready to move higher. Now, the only indicator of concern to me is the predicted RSI at 83.1. But what I've talked about here on Trader Planet for probably the last 7 or 8 years is that the dollar yen moves with the equity markets. So The equity markets are moving higher indisputably, but remember what I've said, that in January, if everybody starts taking profit in January, then that could be a real problem for not just the S&P 500, but also for the dollar yen. So the S&P 500 and the Nikkei go up, dollar yen goes up. If it goes down, if those two major indices go down, dollar yen goes down. So again, keep this in mind. And once again, we're already, I think, up almost 2% on the month for dollar yen already. So this rally is certainly getting tired, but at the particular time, I would say we're probably moving towards that 120. Now, again, going back into 2015, the start of 2016, we can see that December rate hike that actually once we got the rate hike at the 120 area that everybody had worked in, the dollar yen spent most of the year moving lower. So could this cycle repeat itself? Absolutely it could. So an initial move here, when we look at it on the longer term chart, the next move is of course back up to this 120 area. But I think at that particular time, we're going to have significant issues. But again, we're 100% dependent on the FOMC, and whenever we're dependent on the FOMC or some kind of data to dictate what's going to happen with our trade, we don't want to trade that. We want to stand down during that time, let the event risk pass, because dollar yen is going to feel the heat more than any of these other currency pairs. And once again, it all depends on the Fed's statement, but when we look at this rate hike from 2015 going into 2016, it did absolutely nothing for the US dollar. And remember, we've got the wild card, which of course is Trump, and then of course the other wild card is that if even I'm half correct in what I've suggested with people taking profit in the first part of 2016, sending the equity markets lower, that's strike three for dollar yen to go lower. So I would expect a strong week on dollar yen, pushing towards the 120 mark, maybe even getting to 120 by the end of next week after the Fed hike, but then I would think it would start its descent back down into the more reasonable area around that key VantagePoint 18-day predicted EMA, which is already sitting down all the way down at 112.42. So again, longs are okay, but I think it's not a long-term trade here, guys. I think it's a very short-term trade, and we should expect a significant corrective move lower after the FOMC, regardless what they say. Now, with US CAD is moving lower based on rising oil prices, rising equity prices. That's what's the driver of the Canadian dollar. Surely it's not the Canadian economy. Canada has again with the new Prime Minister in Canada, Trudeau, things are not going well. Budgets are way higher than they're supposed to be. It's not good at all here. The Canadian economy is not great at all. So the Canadian dollar is right now riding on the piggybacking on the US dollar strength. You can see it in the crosspairs. Rising oil prices, again, rising oil prices is the only thing that can save the Canadian economy right now and the Canadian dollar. So we'll see if this one plays out. But again, if those equity markets sell off, then you can expect US CAD to rise. And again, remember what I said at the beginning of the presentation, that globally, most people are moving away from fossil fuels. And when they do, that is an absolute negative for the Canadian dollar, because they're so dependent on oil, and dirty oil, like oil sand type oil. So it's not going to be an easy ride here in 2017 for the Canadian dollar, in my respectful opinion. And this is likely only a corrective move. We can see that the medium-term predicted difference is starting to flatten out. And a point of interest here about getting into a trade early, we can actually see the strength indicator and the short-term predicted difference rising up while the market's actually moving lower. So, that's a problem. Now, the one thing that I will say, that this breakout point from the Brexit rally basically tells me that the Canadian dollar went higher. Based on that, it's already showing signs that it's not that happy with the potential Trump presidency, and it's starting to move lower now. The US dollar is losing ground against all things the Canadian dollar, which really makes no sense. When you look at the US economy, no matter how bad it is, the Canadian economy economy is much, much worse. So on a currency this is basis, you would think that they would be more inclined, to be buying US dollars against the Canadian, and I think that they actually will once we get the equities moving lower and once we get oil moving lower again. But we want to watch our indicators very closely. Our predicted RSI is oversold, 17.8. We should expect a significant bounce next week on US Canada, potentially back up to the 133.90 area. But we're going to need oil prices moving lower. We need the equities to just kind of start going flat again here. But those commodities, gold, I don't see any hope for gold in the next 3 or 4 weeks. 2017, that's a whole different ball game. But for now, I would expect that the Canadian dollar should start to weaken into the Fed announcement. Now with Aussie and New Zealand, they are the two pairs here that, the final two commodity currencies. But what I want to point out here is that, we always want to be able to identify ranges. And most people identify ranges by taking a high point and a low point, and then they split the middle with a type of grid formation. But the fact of the matter is Aussie US and New Zealand US have stayed predominantly within the Brexit range. That's predominantly where they've traded. They've tried to break out in a few different spots, but each time you can see they have moved back inside. Then we had a significant sell-off, but we actually stopped exactly on the bottom of the Brexit bar, and we're starting to move higher here. So our key vantage point level for next week is 74.58. Now, what we're looking at from 74.58 is a sustained break on either side of that, so we can either get long or get short. We are very highly congested here, which suggests that it's got a slight bias to the upside. However, the Aussie dollar, the New Zealand dollar, they prefer gold prices, metal prices, iron ore prices moving higher, and they're not. So but remember again, going back to what I've said about gold at the beginning of 2016, after that Fed rate hike in December 2015, gold actually went higher. New Zealand US, Aussie US, they were mixed, but if we look back a year from now, from where we were, you can see that the Aussie currency bottomed out at 68 and then it rallied all the way up to 78. That's not actually a huge move. It's about 1,000 pips, but we haven't made a new high since then. In 2016, we've made that high point at about 78.20, but we've never got above that since then. So when we look at all of these additional highs, they are predominantly all a series of lower highs. So the predominant downtrend, I would say, remains in place, but we want it for next week. We want to make sure we're keeping a very, very close eye on that key vantage point 18-day predicted EMA. Now we have closed slightly below that, suggesting we are going down to 73, but at 73, guys, we want to potentially look at buying this. But again, it's going to be very, very dependent on what we get from the FOMC, because that's going to affect the carry trade. If the US raises rates, well, it's no longer a funding currency per se. More currencies like Swiss franc and Japanese yen are. So the Aussie could get hit by the US dollar. But right now we're seeing the exact same thing with New Zealand US. We've got a very congested area of supply and demand right in here, but we are remaining within the Brexit range, and New Zealand has been even more predominant. You can see we tried to break out here, a series of attempted failed breakout here above the Brexit range. It looked like we had the breakout we were looking at back in September, only for it to fail yet again. We come back up. Once again, we make a series of lower highs, and down we go yet again. So once we hit that high point in September on New Zealand, we haven't been able to get past it since. So our key vantage point level, 71.18. We're closing at 71.33. We're looking for we want the market to break away from this level. Right now, we've got a triple EMA cross in here, but our indicators are extremely mixed here. We can see that our medium term is crossing over our long term predicted difference to the downside here. We're below the zero line on our predicted MACD, and we've got a falling RSI. So again, we are likely to correct lower prior to the FOMC on Wednesday back towards this 70 level. We may get a big shock after the Fed and it could drive it into that 70 level. But I think ultimately New Zealand is probably going to move higher in 2017. When we look at it from 1 year ago, much like New Zealand, you can see it. We sold off going into essentially the end of January, and then that was it. And then we basically just moved higher. We stopped up here in September, and now we're correcting lower, but make no mistake, New Zealand has had a pretty good year against the dollar, and so is the Aussie. So we could be looking to add to that, but we're waiting for that all-important Fed announcement and that economic projections. I'll be watching it very closely, and that is going to be a determining factor, not just for the end of 2016, but for the first quarter of 2017.